This is Real Estate This Week with Stephen Gasquet, continuing 16 years on air and online, helping you succeed in buying, selling, and investing in property. The best real estate strategies out there just for you.
Welcome to Real Estate This Week. Hi again, I'm Stephen Gasquet, and I'm so glad you're here as we look at mortgage interest rates, where they are now, where they're headed, and what it all means to you. Whether you're buying property, selling property, or investing in property, this is crucial information you need to know. And our guest today has a fascinating perspective on this, because while most economists believe that mortgage interest rates will fall somewhat this year and next, our guest asks, but what if they don't? Joining us now is Holden Lewis, mortgage reporter and senior writer at the financial website NerdWallet. Holden, welcome to Real Estate This Week.
Thank you. Pleased to be here.
I am so glad you're here because we're going to be talking about one of the most important parts of real estate, mortgage interest rates. Now, right out of the box, how are mortgage interest rates now, and how will they be for the rest of the summer?
Right now, mortgage rates are they're between 6.5% and 7% for the 30-year fixed rate mortgage. And I think that's just a little bit too high for a lot of buyers. There seems to be a sweet spot lately, and that's 6.5%. When rates get down to 6.5%, maybe a little bit less, it really does bring out the buyers. And so, with mortgage rates north of 6.5%, people are reluctant to buy. They're looking at those prices. They're looking at the interest rates and just saying, you know what? I'm going to wait a little longer. I'm going to wait and just see if mortgage rates go down. So that's happening. So what do I think is going to happen the rest of this year? I think mortgage rates are going to be, they might fall a little, but I really do think that they're going to spend most of the year above 6.5%. So that's going to be a disappointment for a lot of buyers. Come fall, if they're hoping, hey, I can take advantage of lower interest rates and there's going to be a lot of houses on the market to choose from. Maybe I'll be able to get a bargain then. Well, I'm not sure that mortgage rates are going to cooperate too heavily on that.
And what about the strategy of going ahead and biting the bullet and getting a house now with today's mortgage interest rates, with the plan of refinancing later if they do drop in a measurable way?
My outlook on this is a little bit less optimistic than a lot of people. I just think that when you buy a house today, you should not count on being able to refinance at a lower rate within the next 5 years or so. It would be great if you could, and maybe you can, but I wouldn't count on it. If I were buying a house today, I would say, all right, can I afford this interest rate for the next 5 years or so? And if it would be a stretch, maybe it would be best to wait and just to see if mortgage rates go down, because no one wants to get stuck with a really high house payment that, they can't afford to go on vacations. They have to buy a used car instead of a new car, that kind of thing.
I see. And that is a very careful and very conservative approach, because you're not just jumping in just to get a house, but you are getting in with your eyes wide open. You know exactly what the costs are going to be. And then in the future, and as you say, maybe even the distant future, you might have an opportunity to refinance. I think that's a really wise approach, Holden.
Thank you. Now, when you look at other forecasters, they're a little bit more optimistic. Fannie Mae and the Mortgage Bankers Association, they expect mortgage rates to fall over the next year or so. So by next summer, they're thinking mortgage rates will be oh, in the range of like 6.2% to 6.6%, which is, it's lower than rates are now. That would be a very hopeful sign if mortgage rates do fall like that. I'm just not sure that they will. I keep thinking that rates are going to fall and they don't, not appreciably. So I'm at the point of saying, okay, fine. I guess they're just not going to fall for a while.
That's a really solid approach, Holden. I mean, it's like coming up with your household budget. It should be based on what you make right now, not on a promotion which will pay you more that you don't even have yet. And if you bring that back to the house, it's better to get a mortgage that you can afford without any question. And then down the line, if mortgage rates do drop, great, refinance. But if not, you're still in affordable housing.
That's right. And I would add one thing to that on the affordability issue, and that is it's wise to build in rising home insurance premiums, especially, say, in the South or in Hurricane and Hail Alley, going up from Texas into Nebraska. In along the Gulf Coast, along the East Coast, and in Hail Alley, as I call it, home insurance premiums have been rising pretty fast. And so that is actually really harming affordability. Even people who've owned a house for quite a long time, some of them are finding it very difficult to afford their monthly house payment just because the insurance premiums have gone up.
That's very interesting. And we should remind people that if you get a 30-year fixed rate conventional mortgage, the mortgage will not go up for 30 years, 360 payments, but that's not the only cost you will pay for that house. As you say, insurance premiums can go up. Also, your property taxes can go up. If you're living in an HOA community, those fees could go up. And so, it's true. You need to plan for affordability, not just today, but in the future as well.
Exactly right.
So, Holden, let me ask you about an old-fashioned way to figure out what you can afford. Back in the day, we used a ratio called 28-36. And that meant that your total gross monthly income, not your after taxes, but your pre-tax income, that 28% or less of that should go to your housing expenses, and 36% or less of that should go to all your revolving debt, which is your mortgage, your credit cards, your car payments, your student loans, all of that. And that formula would help people achieve affordable home ownership without a crisis every time there's a big bill. What do you think of that old-fashioned way of assessing what you can afford?
I still think it's valid. The problem with it is that it seems old-fashioned. What I mean by that is just the cost of housing keeps going up, and people's debts keep going up, especially if, say, they had student loans in college, or they bought a new car, and those are extremely expensive. And so for most of the country, that 28-36 rule is just really, it's very, very tough. It's very tough to find a house that's going to cost you 28% or less of your pre-tax income every month. But, just for long-term financial health, being able to save for retirement and not having to retire when you're 75, it really is important to try to keep that ratio as low as possible. To if you can get by with 30% going to your house instead of 28, if that's kind of your rock bottom, then maybe that's what you have to do. But it sounds easier to say than it is to do. I realize that.
You're absolutely right, because I think the mortgage industry has also recognized that. And in many cases, their ratios are more like 40 or 45%, and in some cases, all the way up to 55%. Because just as you said, life has changed in America.
Think about someone who rents a place and it's taking up 50% of their monthly income just to pay the rent. And then they can buy a house with an FHA loan that takes up 45% of their monthly income. Owning the house is actually less than the rent. That is a case where, okay, you're way over those ratios, but you're still saving money by buying. Now, we're not seeing that happen in a lot of markets nowadays, but just a couple of years ago we did. When mortgage rates were a whole lot lower, a lot of people were bailing out of, 50, 55% of their monthly income going to rent and bringing that down to like 45% going down to a mortgage. So, those ratios, you can't look at them in a vacuum. You have to look at it as, okay, what's the cost of ownership versus the cost of renting? And sometimes, even if your monthly payment is way over that recommended maximum, it still might be a better deal than renting, because you got to live somewhere.
You've got to live somewhere. That's very true. Plus, rents typically go up, but the value of the home you buy will also typically go up. And it's kind of like a forced savings plan for your future.
That's right. The home value typically goes up. And I want to add, for those people out there who are kind of waiting for a housing crash to happen, I just don't think it's going to happen. And I got to tell you, I was a real estate and mortgage reporter back in the early 2000s. And starting around 2004, I thought, oh man, we're in for some trouble. Especially by 2005, I just thought, okay, there is going to be a housing crash. I thought it was going to happen sooner than 2008. But we really started seeing signs of it in 2007 when the subprime started to fall apart. That's just a long way of saying that I had a pretty good sense that we were in a bubble back then and that it was going to burst. I do not have that sense now. We're not in a bubble, and I just don't think that a housing crash is in the cards.
So in our conversation about mortgage interest rates, let me ask you the fundamental question. In your opinion, Holden, as an expert on mortgages and someone who has covered the mortgage market and the housing market for decades, is now a good time to buy a home?
Believe it or not, I think it is actually a good time to buy a home in a whole lot of markets. And the reason is that inventory keeps going up. So what does that mean? Well, it just simply means that there are more houses on the market than we've seen in about 6 years. So if you're buying a house, you have more homes to choose from in most markets than you did anytime since the pandemic began. You have a greater choice, and you have a little bit more competition among sellers. We're getting into a situation where we have a more balanced market. It's not the sellers who hold all the cards. The sellers in most places really can't dictate the negotiation. In most places, it's more balanced. It's more of a give and take. And then there's a few markets, like especially in South Florida, where the buyers really do have more negotiating power than the sellers. And so just from the standpoint of greater competition among sellers and more homes to choose from, in a lot of this country, it really is a pretty good time to buy. Now, the exception is mostly in the Northeast, especially New England. And kind of ground zero for that is Connecticut, where there just aren't nearly enough houses for sale to meet the demand. So you see that in a lot of New England. You see that in places in the upper Midwest too. But if you're looking at just about anywhere in the South, especially Florida and Texas, Louisiana, you really do have a good choice of homes, and you have sellers who are going to have to actually negotiate with you.
Interesting. And Holden, about that prediction, do you believe that the increase in homes for sale that we're seeing in the South and in some parts of the West will spread up into New England and up into the snow states? Or will we remain in a situation in which inventory is big down south, but not up north?
My guess is that we're just not going to see inventory increase a whole lot up north. And the reason is that it's just harder to build there. These are places that have been settled for centuries. There's just not a whole lot of places to build. Plus, you have a lot more regulations in the Northeast and kind of in the North generally. And so, it's just that kind of lack of land, lack of places to build new construction that is going to keep inventory tight in a lot of the North. Now, as far as the South, there's more room to build and the regulations are looser. And so therefore you just see more construction, and that's going to keep prices from skyrocketing, at least. It's going to allow people to, it's going to allow buyers to look at both new construction and used houses. And, as those two compete with each other, it kind of keeps the prices down on both new and existing homes.
Well, Holden, I can always count on you to give us the straight story, exactly what your data show and what your conclusions are. But tell me, what else do people in today's market need to know about mortgage interest rates?
That they really are heavily dependent on inflation and kind of generally what the Federal Reserve is expected to do. And just a few months ago, people were expecting the Fed to have cut short-term interest rates at least once by now, and to be cutting a couple more times this year. I think we're looking at maybe the Fed will cut one time at most this year, maybe in December. And so that in itself, even though the Fed doesn't control mortgage rates, they sort of set a market signal of which way interest rates are going to go. And if the Fed just kind of sits on its hands and waits and doesn't cut short-term rates until, say, December, then you're going to see mortgage rates just kind of chug along where they are, between 6.5% and 7% for the rest of the year.
Well, Holden, I really want to thank you for your very thorough analysis of mortgage interest rates right now and through the end of the year. And I want to thank you for explaining to everyone, including me, about what they mean to us and our real estate plans. Thank you, Holden.
Hey, it's my pleasure, Stephen.
Always ours too. Holden Lewis, mortgage reporter and senior writer at the financial website NerdWallet.
You're listening to Real Estate This Week with Stephen Gasquet.
And now, it's time for Beyond the Basics, in which we bring your real estate knowledge to the next level. And today, let's talk about protecting yourself by holding on to one of the most important documents you will ever receive, your mortgage satisfaction letter. It's not really an unusual document, because anytime you have a mortgage on your house or a second mortgage or a home equity line of credit or any other type of loan that uses your house as collateral, well, when you pay it off, you will receive a letter from the lender saying, yes, that loan has been completely satisfied. Now, sometimes that payoff happens when you reach the end of the mortgage and you make the very last payment. Now, if that's the case, congratulations. But more often, the payoff happens when you sell the house. Because when you sell that property, all the mortgages, all the second mortgages, and all the loans on it are paid off at the settlement table. And when that happens, watch your snail mail very carefully. Because several weeks after you sell the property and all those loans are paid off, you will get letters from every lender you worked with on that former residence. And you might think, oh, no big deal, that's my old mortgage, who cares? And just toss the letter out. Please don't do that. Instead, do the very opposite. Open that letter. And if it is the mortgage satisfaction document, put it right there in the safest place you have. Put it right there with your deed, with your will, with every document you consider to be incredibly important. Because the satisfaction letter is. It's proof that the mortgage is gone. And you might be wondering, why do you need that proof? Well, you will need it if the lender you used to work with is sloppy, if they never got around to sending you that letter, or if they sent it to the wrong address, like the house where you used to live, instead of your new place. If you don't have it, it probably won't matter right away, but down the line, when you buy your next house, you might discover a mistake, that the loan on that old house was never officially registered as paid off. And that can be a real headache. You or the title attorney would have to go back to that old lender with the account number, the address, and the rest of the information for that old mortgage. You'll have to hope they can find the records. And if not, you might have to go to the county clerk and see if they registered the mortgage as paid off. It is possible someone along that line did make a mistake. Yep, it's possible. And yes, it happens. But you can avoid all that by holding on to your mortgage satisfaction letter. Keep it in a safe place and realize that even though you don't need it now, it might be crucially important to you in the future. And by the way, it's not just the house. Whenever you pay off a big loan, typically the lender will send you a satisfaction letter. Like if you pay off your car early. Hold on to those too. If you do, you'll be protected well into the future. Think of it as an insurance policy against big future hassles. Hassles that can be completely avoided by just safely holding on to a very important piece of paper. Next time on Real Estate This Week, a special report on short-term rentals. We'll take you to Lake Michigan, described as a battleground where some people want Airbnb, VRBO, and other short-term rentals banned, but others don't. That's next on Real Estate This Week. And until then, I'm Stephen Gasquet, and thank you for listening.
A brand new episode of Real Estate This Week with Stephen Gasquet drops every Thursday, everywhere. And you're invited to listen, subscribe, and follow us. Just look for Real Estate This Week with Stephen Gasquet. The best real estate strategies out there, just for you.